Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about some of the best stocks to buy right now on the stock market. Now, this list that I've composed is very special because not only has it been reviewed by Morningstar analysts, but these companies mix the best in terms of dividend stocks, undervalued stocks, as well as growth stocks. So by investing into these companies, which I personally am also buying, you get a little bit of growth, passive income in the form of dividends, and these companies are technically undervalued. So I hope you enjoy videos just like this one. If you do, don't forget to annihilate that like button right now. Go ahead, press it right now because it helps me out a ton. Subscribe to the channel for more videos just like this one. Join and become a member of this channel for secret videos very similar to this that I only give out to my members, and you can become a member for as little as 99 cents, so you literally won't even feel it. But with that being said, I hope you enjoyed, so let's jump right into today's video. Starting off our list, let's talk about MasterCard, which is a phenomenal company to hold in your overall portfolio. MasterCard is the second largest payment processor in the entire world, and it has brought in very solid first quarter results despite macroeconomic uncertainty and overall volatility within the market. The company will also benefit from the ongoing shift towards electronic payments. That's why MasterCard stock right now is trading below their fairly valued estimate by professionals by lower than 1%, meaning that their fair value is around $386. So we can tell that this company is undervalued. And on top of that, the company offers their investors a dividend yield of 0.57. So not only are you getting this company at a discount, this company also has phenomenal growth and a decent dividend. Now, a lot of the companies on this list are going to be decently high in their overall per share price, meaning that I hope you have a brokerage that offers fractional investing or share slices, so you can invest into these companies for as little as just $1. I know Robinhood, Webull, and a couple other platforms allow you to utilize share slices and fractional investing. However, if you don't have those platforms, I would highly recommend you look into platforms that allow you to invest fractionally. With that being said, let's move on to our next pick, which is S&P Global. S&P Global has carved out a very wide economic moat, especially in regards to their data-driven benchmarks, which are focused, and it's where the company specializes in credit markets, financial indexes, and commodities pricing reporting. Every time you hear S&P Global or S&P 500, this means that it is coming from the Standard & Poor's Global company. As of right now, due to the firm's very global diversification, this offsets risk and weakness in their overall business. And as of right now, according to Morningstar analysts, the company is trading at a discount to where their fair value is $370, and that is discounted according to experts. Now, despite this, the company could surge up to $434 over the next 12 months, while also offering a very good dividend of 0.96% in regards to their dividend yield. So again, we see a company that's not only undervalued and is trading 1% below their overall fair value estimate according to Morningstar, but the company also has a phenomenal growth opportunity, and it also gives us a pretty good dividend. So even if you are a growth investor, a dividend investor, or an investor that likes to identify undervalued companies, then these are the companies for you. And as we go higher on this list, the companies get better and better. Up next, we have a favorite of mine, which is Microsoft. And Microsoft, as you probably know, is one of the largest companies according to their market cap on the stock market, and they have consistently given businesses various tools and products so those businesses can be successful. On top of that, the company has transitioned from their traditional licensing model to a subscription-based model, which increases their overall revenue. Due to their very incredible demand for their products, they are anticipated to hold a market leader position for over the next decade. Microsoft is also extremely strong due to their very impressive balance sheet and their overall investments. Now, with that being said, the company is just overall fundamentally solid. It's trading at a 2% discount according to Morningstar analysts because it should be trading for around $325, but currently it's trading below that fair value estimate, so you are getting a phenomenal deal on this company if you bought right now. On top of that, the company could surge up to $400 over the next year, and they also offer a pretty decent dividend coming in at 0.78, and that would be in regards to their percentage dividend yield. Next up, we have the number one payment processor. We already talked about MasterCard, which is the second largest payment processor, but now we have the number one, Visa. I personally own both of these companies because I take a co-opetition approach. If I buy Visa, I'm going to buy MasterCard. If I buy Target, I'm going to buy Walmart. If I buy Lowe's, I'm going to buy Home Depot. If I buy Coca-Cola, I'm going to buy Pepsi. These are the types of co-opetition approaches and investing style. So regardless about which of these companies becomes the dominant market leader in their industry, either now or in the future, I am anticipated to get growth from both of them very handedly. So Visa is a phenomenal company to own. I own it in my personal portfolio, and they are the largest payment processor. Visa has been a long time market leader in their respected space, and they still have phenomenal growth prospects. They brought in quarterly results recently, which were absolutely magnificent, and despite macroeconomic downturns and volatility due to the impact on customer spending, this company is still going strong. Right now, they're discounted at around 3%, and who doesn't want to buy phenomenal, fundamentally solid companies that are trading at a discount? They should be trading for around $241 is their fair value estimate, but they're trading 3% below that. Plus, we can look forward to future growth in this company to where they could explode up to $300 over the next year, while also offering investors passive income in the form of a dividend of 0.73% regarding their dividend yield. So again, we have identified another phenomenal discounted growth company that also offers a dividend. Next on our list, we have ASML Holding, and this company supplies photolithography equipment for semiconductor manufacturers. The company is also set to benefit and grow from the proliferation of extreme ultraviolet lithography and leading-edge chip makers. But I also want to make investors privy to the fact that the company could surge up to $853 while offering passive income in the form of dividends regarding their 0.94% dividend yield. So again, great discount, great growth, and a pretty decent dividend. Next up, we have Rockwell Automation, which has one of the highest dividends on our list. Rockwell, if you're not familiar with this company, is a high-quality automation company that seeks a stronger footing in the overall technology markets. Their main goal is to create a stronger foothold in where technology meets traditional manufacturing. And according to professionals, this is a great company that has recently seen a surge in their overall revenues, making their recent reports for their earnings reports very impressive. Rockwell Automation is also discounted by close to 10% because their fair value estimate should come in at around $310 according to Morningstar, but the company still has significant amount of upside, up to $335 over the next year, and they have one of the largest dividend yields on our list, coming in at 1.61%. Again, overall, this is a phenomenal growth company that offers a strong dividend and it's discounted. So why not look further into these companies yourself? Because it doesn't really matter which investing style or strategy you are using, these companies could make your portfolio even more resilient, safe, and give you plenty of well-deserved returns. Next to it, we have Intuit, which is a large cap giant that focuses on small business accounting. They are most notably known for QuickBooks as well as TurboTax, which I personally use. Morningstar also commented that they like the company's internal innovation as well as their synergistic acquisitions, meaning that they are buying companies, in which case the company could use to make even more revenues. They also had very good quarterly results come in, and their forecasts looked very impressive. The company is currently trading at an 11% discount, which is very, very intriguing because the company should be trading at around $503. The company also has phenomenal upside potential and a long-term time horizon over the next 12 months to reach $565 while giving you passive income with a dividend yield of 0.72. So another company definitely to add on your list, and I personally own Intuit as well. Next up, we have Autodesk, and they are considered to be one of the largest global industrial standard computer-aided design software companies. This company helps out other firms which are involved in architecture, engineering, construction, and product design, as well as manufacturing. Management, according to Morningstar, has done a great job in exceptional job, according to their own words, for their internal investment strategy. Right now, it's trading at over a 13% discount in regards to their overall share price, because it should be trading at around $230 right now, meaning you are getting a fantastic deal by buying this company right now. They do not offer a dividend, but there is a further upside growth potential throughout the rest of 2023 to $265. Another phenomenal company to add to your portfolio, or at least look further into. Next up, we have a company that does offer a very impressive dividend yield, coming in at 1.25%. Ecolab is a global leader in the cleaning and sanitation industry, which specializes in the cleaning and sanitation of hospitals, food services, and other healthcare customers. The first quarter results for this company came in very, very consistent to where investors really took notice. On top of that, their prices rose by around 13%, which led to these greater revenues. And despite inflation, these higher prices are fighting against that. The company is also on track to enjoy profit growth and margin expansion for the rest of 2023 and well into 2024. And despite this discount of 17%, meaning that right now is one of the best times to buy this company, it could still grow to around $213 while also giving you a very strong dividend yield. Lastly, we have Tyler Technologies, which does not offer a dividend, but the upside growth potential is quite impressive. Tyler Technologies is a mid-sized growth company, so it's a mid-market cap company, and they are a leader in their respected space regarding the government operational software space, and this is a very niche market. Their first quarter financial results for their earnings report came in better than expected, especially as they landed a lot more software as a service deals. The analysts over at Morningstar believe that the demand for this company remains healthy well into the future, so management reiterated their guidance for this company, which was very strong. Analysts expect consistent and stable growth throughout the rest of the year and for their margins to expand, meaning that in the future they are going to bring in even greater revenues. Tyler Technologies stock is currently trading at a 17% discount from their fair value estimate, while also trading well below the share price that they could meet throughout the rest of the year, coming in at $500. So all of these companies, which you can see here at the top right of the screen, are absolutely phenomenal, and I would highly encourage you to do your own research to make sure these companies align with your own risk tolerance, your investing style, and the variables you have for your portfolio. With that being said, if you enjoyed videos just like this one, don't forget to go and annihilate that like button right now. Comment your thoughts down below if you personally own any of these companies. Subscribe if you are new, and I will see you in the next YT video.